Hi guys, welcome to Investing with JYK, and today we'll talk about another leveraged gold play. This is a company called Dynacor. It's a tiny company of a market cap of 50 million US dollars. Volume is very low. You can see daily volume was like 1,000 for the last day before Christmas, which is a half day. But even before, you can see these are very choppy curves. That's the ADR. Even if you look at the Canadian one, you can see that price really doesn't move much. The liquidity is very limited. So keep that in mind. Don't rush. For disclosure, I haven't bought this yet. I've been considering it, and I may or may not buy this. So the idea is that I don't really want too many gold miners because they're the whole option-like thing, because a lot of them behave almost like options here, destroyers of capital. This thing, even though it calls itself gold mines, most of its income doesn't come from mining. In fact, zero of its income come from mining. They have some exploration, which in my mind is actually value destroying, but that's for a later discussion. So their business model is really they have a mill, a gold ore mill in Peru, and they buy ores from individual Peruvian miners, like artisan miners and small-scale miners. They process their ore, and so Dynacor would process the ore that the artisanal miners produce and sell whatever gold comes out of it into the international market. Obviously, you can't sell ores long distance because the value in the ore is quite low, because a typical gold mine have a ore grade of less than 5 grams per ton. So 5 grams of gold is $200, and a ton, even if you just transport it by, say, rail. So one idea is that, remember I was talking about how High Crush, I liked High Crush, but that thing has crashed, which is unfortunate. But the number is still useful. So in US, to transport 1 ton of sand from Wisconsin to the Permian Basin is like $80 or $70. So you can see how it very soon the cost of transportation would eat into your $200 ore value. So, and the other thing is building a mill, unlike actually mining, which probably just takes shovels and hammers and stuff like that, is very capital intensive. So the artisanal miners don't really have access to that capital. So I think that they found themselves a pretty good niche. And the other thing is they don't have to worry about typical stuff like life of mine, because their ore is not coming from a single mine. Their ore is coming from a wide region in Peru. Okay, so that's what we have, and so let's approach this a couple of ways. So why does this have leverage to gold? Well, and then how does this compare to a gold miner? So for a gold miner, the cost of producing each ton of ore and processing it remains approximately the same, subject to like inflation and fuel costs and stuff like that. But it's mostly independent of the gold price. So when gold increases in price, almost every bit of additional revenue should, in theory, fall right down to profit, because most of it is fixed cost. And the variable cost doesn't change either. In Dynacor's case, imagine if the price of gold increases in the global market. The miners, the artisanal miners, will not sell you the ore at the same price as they did before. So they would increase their price. So the variable cost for Dynacor would go up. So their margin does not, so the additional revenue doesn't directly translate into additional profit. But they probably can keep their margin the same. So basically what they end up with is still increased revenue and proportionally increased gross margin, but their corporate expenses, so overhead, shouldn't remain the same. So that's where they get the leverage from in terms of gold price. But it will definitely be lower. But the nice thing about this is they're already done with most of their capital expenditure other than their exploration, which I think is value destroying. But at the moment, they're cash flow positive, and they have no mines to depreciate, because replacing a mine is very expensive. Replacing machines, because you have like the uncertainty of finding a new mine. Replacing machines in essentially a factory is a lot more predictable. The cost of the machines will go up with inflation, but most likely it's not going to be very dramatic. So that's why I like this a bit more than normal miners. Okay, so let's dig a little deeper. So first of all, let's look at their past 5 years. You can see revenue dropped as the price of gold dropped, and gross profit dropped as the price of gold dropped as well. And if you look at the gross profit margin, gross margin actually dropped all the way to 2017. So there is something here, because this number is not normal, but the reason this is lower is that they had 2 processing facilities and they were only using one of them from this point onwards. So they had an old one. If you look at, see, you can see that they have 2, Veta Dorata and then Metallex. Metallex is the old one, which is now completely shut down. So the gross margin should recover. And Meta Dorada is the supposedly lower cost, higher capacity, and they're saying that they are saying that they want to increase it to 360 ton per day by end of this year. Whether they can achieve that, that's beyond the point, but basically at the moment they are 300 ton per day. Now, imagine if you get, let's say, 5 grams of gold per ton, that's 1,500 grams of gold, and that is to troy ounce is 48 ounces per day, basically. And then if you multiply, say 50 ounces, 350 days or something. 1,700 and 500. So let's say 17K ounces per year. So that's about the amount that you can expect. And I think we can check the numbers later if they actually produce that much. All right, so let's keep looking at this thing. EBITDA margin bottomed at 2016, which makes sense. That's when the gold price started picking back up. And keep in mind, and then the main reason that's happening, even though the gross margin didn't increase much, since 2016 is that the revenue actually increased. If you look at revenue, it actually increased 20%, and SG&A remained stable. That's what we like to see. SG&A and interest expense added up to about $6 to $7 million, and that's stable regardless of how much revenue they get. So that's the income statement. Now let's look at balance sheet. Are they in the do they have the chance of going bankrupt? Actually, no. So if you look at just dollar amounts, they have $5 million in cash, and that their market cap is 60 million in Canadian dollars. This is all in Canadian dollars, I think. Oh, this is now in freaking USD. Okay, so 50. And then they have these receivables. So that's something I'm a little bit worried about. I think it's not in their annual report, but basically they sell all their gold to one guy. And then they have inventories. So I checked their inventory notes. Basically, 5 million of that is gold. The other sum is there was another million in ores, unprocessed ores, and then about 600K in prepayment. So I think the way they work is that they prepay these artisanal miners for their ores, and then these artisanal miners will then bring the ores in. But at least out of that inventory, 5 million of that should be readily saleable. So once they convert that fully into gold, they can then sell that on the international market. And gold is very liquid, especially for just $5 million of that. So you can almost think they have like a $10 million in terms of liquid assets. And we're not considering receivables, which is, I think, extremely conservative. Okay, and then let's have some properties and plans, including their expiration, but imagine that's all zero. Now let's go down to here. They have some other current liabilities, whatever, accrued liabilities, $4 million. And they used to have $6 million in debt, but that's paid off. So they basically have zero debt at the moment. They have this long-term liability, and most of that is what they promised to do after the plant is closed. So the restoration stuff. So I think this number is very odd. They're missing something here. So basically, they have about 10 million in, the long-term, not debt, not interest-bearing debt, but just long-term liabilities. Total liability is 13 million, and total liquid asset is 10 million. And then if you count in the receivables and you take just 5 million out of that, you're looking at 15 million liquid assets and then 14 million in liabilities. And to keep in mind, these are really long-term liabilities. They only come into effect when you close down the thing. So that's good. So no long-term debt, no interest-bearing debt, and enough liquid cash. And so I think this company is not likely to go bankrupt anytime soon. Right, last thing for the statements, cash flow. So you can see that their operating cash flow was high, and it went to shit in 2016. And that makes sense. That was the lowest point of the whole gold price. And cash flow used for investing, so you can see that they actually spend quite a bit of money, 15, 16, for building the new mill, the new mill, the Vata Dorada, I think. Vata Dorada, yeah. So that will no longer be recurring. That's gone down a lot. And this 1 million, 2 million here are basically exploration. And we can kind of assume that they don't. You can even assume them as losses. So we can then adjust this later again in the income statement. And they paid off a bunch of debt, and they instituted a dividend recently this year. So they just started paying dividend this February, I think. And the dividend, I think, was 2 cents per quarter, if I'm not mistaken. 2 Canadian cents, I think. Let's see, 1 cent. It doesn't say anything. Let's see. This is dividend. Where is my dividend? Okay. Quarterly dividend in August. Sorry, August. So that's the first ever dividend payment that they paid out. And I think they can sustain it because they no longer have debt. They no longer have any capital expenditures other than their exploration. And so, okay, so that's 1 quarter, so that's 0.0077. Okay, so 1 cent, 1 Canadian cent. So 4 cents per year. And then 4 cents per year, their number of shares outstanding is this, right? So let's see how much money they need to use. So they need to pay out $1.6 million. And then if you look at their cash flow, it's quite a bit more than that. You're looking at $9 million in free cash flow. And they're promising to pay out just 1.6 million. Okay, so let's look at income again. Now, remember I said that they were doing this exploration work, assuming that is gone to zero, right? But that's not reflected in the income statement because these are capitalized. So let's adjust the income statement to remove any exploration expenses. So that was 1 million and 2 million. So you should then remove 1 million and 2 million here. So that would be a 3 and a 3. So $3 million in profit, quite a bit more in cash flow because they just built their mill. So the maintenance cap hasn't kicked in just yet. So both from income standpoint and from cash flow standpoint, they can sustain the dividend, no problem. And now once you adjust it, their yearly income is going to be about $3 million, which translates to a little less than 20 PE, because here it says a 10 PE, but forward 10 PE. But let's say it only makes 3 million, so 18. Right, so 50 divided by 3, that's like 16 P, which isn't that high, and you are still exposed to the upside of gold. Okay, so a couple other things to keep in mind. Oh, yeah, this is somewhat useful. The gold production, let's see, gold production. So gold production, when I calculated it, I was like saying, okay, maybe we'll make 16,000 ounces, and actually they make a little bit more, so maybe the grade is just a little better, but it's in the same ballpark, so that checks out. And then they have been processing more and more gold, so that's good. And then the other thing is, can they keep the gold coming? And then one thing that's nice is Peru is saying they want to legalize artisanal and small scale miners, so they no longer become this they become no longer this gray area. All right, well, some more risks. Are the managements at least trustworthy, or are they like just at least ballpark passing the bar? Okay, so first of all, you can look at their salary. Their salary plus bonus is there's basically two executives, $300,000 to $400,000, which is quite a lot considering the company only makes, according to GAAP, 4 to 5 million. So they're sucking up. So that is basically 20% of the company's profit. Obviously, it's in addition to the profit, right? Because if they took less, then that becomes profit. So that's one problem. And the other thing is, how many shares do they hold? Are they, 50% shareholder? Then they basically probably shouldn't have an incentive to increase their salary that much. They probably just want the price to go up. Or do they hold no shares? So these two guys hold, I think it's in some. Oh, it's funny thing is, normally you would find this information in the annual report, but in case of a Canadian company, apparently it's in the shareholder meeting material. It's not in the annual report. I was looking for that for a while. I couldn't find anything. So these two guys. Okay, this Sean Martino guy has 1 million shares, and he has some options, and he has some deferred share units. So, but overall, let's say 1.1 million shares approximately. And this this guy, this Pierre Lepine, has quite a bit of shares, 100K. Okay, and then these guys, this Eddie Canova is about 100K, 150K, 150K here. So these directors are actually hold some shares and hold some options and hold some deferred share units like RSUs. And the guy that I wanted to find is a CFO, Chief Financial Officer. Okay, this Leonard, he has some share-based compensation. And he has some options. But I'm really looking for and that's a golden parachute, by the way. This is the golden parachute. So basically, if the company gets bought out, they will get paid in total $1 million, which is quite a bit, but not ridiculous, I would say. For a company that earns $4 million a year, has a revenue of something like 100 mil, doesn't sound too crazy. Okay, so I can't find anything that says Leonard has many shares. So let's just consider that total these board of directors and the CEO have about 1.5 million. right? So 1.5 million, the whole company has 40 million shares, so insiders own about 4%. And then you look at the exercise price. The guy has some really old options at really low prices, and then their new options are in comparable price, basically current market price. Okay. Oh, by the way, look at this. Think about it. If he did buy all this. He actually took a loan from the company at 4% to take out the, which is kind of a self-dealing, because 4% is quite low. So he paid 33 cents for these shares. He's getting paid 4 cents per share every year now. So he is getting a 12% dividend yield at cost for the shares that he bought. All right, so looking at the management, they are nothing spectacular, and they are not total jerks as far as I can see. Total compensation is 400K, 300K, so quite substantial. But again, it's not. They're not taking $1 million each. Okay, so then the bad part, which is exploration. They have some things. They have two things here. They want to explore, and they say that, oh, there's going to be some gold there. Maybe there's gold, but if I were them, I really wouldn't do the exploration, because I have the perfect business model. I just sit there and process ores and let all the artisans take the risk. I'm just here to process ores, to take a cut. Very simple business. And these artisans probably won't ever get a new processing thing, and all the gold miners don't. Thing is, people that like gold don't like variable costs. They all want fixed costs. They don't like changing variable cost. They want fixed variable cost, in the sense that the variable cost doesn't change with regard to the gold price, and leverage to gold price. That's what they want. But then the ones with the highest leverage to gold price are the most marginal, i.e. the shittiest quality. Right? So I don't see why, if you just take a little bit of that leverage off, you might end up with a much better risk-adjusted return. Okay, so yeah, so they're spending like $600K to $1 million in drilling and all that stuff, which is kind of stupid. Oh yeah, and then last thing is, where are their things? So you got the drilling happening in here, and you can see that is near Cusco. Oh, by the way, I was there. We went over the Salcantine Mountain. So we actually went, like, I think we went from here into Aguascalientes and then into Machu Picchu. So we climbed the mountain here. And let me tell you, the roads there are not very nice. So this Chirga district is where their deposit, their exploration target is at. They got 2 land patches. Okay, so once you mine it, you will need electricity, you will need roads to get it somewhere so you can ship it out, probably somewhere along the coast. And I'm not too confident in, if you look at Google, right, there is no route guidance from the coast to this region, and that's actually a town. So the deposit is not in the town, it's like close by. So it's even worse. So the infrastructure is just not there. So I think this Minata Veta Dorada, Minera Veta Dorada seems like a perfect spot. You're on the Pan American Highway. This is the Pan American Highway, by the way, and next to the coast, and transportation is fantastically easy. And if you need to ever get anything repaired, your replacement comes in very easy and everything. So yeah, okay. So that's all for this time. We have a gold miner that don't really have a mine. It's really a gold processing company, and it gets ores from artisanal miners and sells them in the international market. They make a cut on every ounce of gold produced. They have fixed SG&A, no long-term debt, plenty of cash, lots of gold inventory, plenty of free cash flow, and more than 100% dividend coverage. Even assuming they wasted every single cent that they did on exploration, you're looking at a PE of about 16 with leverage to gold. Just to make sure that I'm being extremely clear why there's leverage to gold. When gold prices increases, the same amount of gold ore will get sold for more. They pay more, but proportionally they pay more, but the absolute amount of gross profit is going to increase. So they get operational leverage basically. Even though they don't increase gross margin. And the other thing is, once gold price goes up, there'll be more of these artisanal miners, because at the lower price, people don't really want to be digging. Give them 20% more, they probably are willing to be digging. So the source of the ore might go up as well. Yeah, so that's where the leverage to gold comes from. And they will not go bankrupt, unlike many other things. They don't need capital. They're at the phase of their life where they throw out cash instead of burning cash. So that's all very good. And be careful with their market cap and liquidity, because if you put a market order, I'm pretty sure somebody will take a good advantage of you. I haven't bought, but I'm considering. My thinking that if this thing drops like $1, which means I get like 4%, 3 point something percent, because one's Canadian cents, I probably will buy some, just as a positively yielding hedge, which sounds pretty good to me. Okay, that's all for today, and see you next time. Don't forget to subscribe.